In 2022, the classic 60-40 portfolio lost 17.5% in a single year. That was the worst performance recorded since 1937, 85 years earlier. On an inflation-adjusted basis, it was the worst year in recorded portfolio history. $9 trillion sits in portfolios built entirely on this one single strategy. And in 2022, the safety net underneath all of it simply collapsed without warning. Subscribe to Finance Insight right now. This story directly affects your retirement money. The 60-40 portfolio is the most widely recommended investment strategy in financial history. 60% in stocks for growth, 40% in bonds for protection. The idea sounds elegant, balanced, and almost unbreakable, until the math stops working. And the math stopped working in the most catastrophic way anyone could have anticipated. Stocks fell 18% in 2022. Bonds fell 13% simultaneously, together at once. That had not happened in 40 years. Not once since the stagflation era of 1969. The bond market, which was supposed to be the safety cushion, became a second wound. Every advisor who ever said bonds protect you had to answer for that simultaneously. $9 trillion in retirement accounts watched both halves of their portfolio bleed out. The Federal Reserve raised interest rates at the fastest pace seen in 41 years. Between March and December 2022, the Fed delivered 425 basis points of consecutive rate hikes. Bond prices and interest rates move in opposite directions. That is foundational fixed income mechanics. When rates explode upward at that speed, bond prices collapse with equal and devastating force. The Bloomberg U.S. Aggregate Bond Index dropped 13%, its worst annual decline in history. This was not a minor dip in bond prices. This was a structural bond market catastrophe. Think about what that means for every retiree holding 40% of their savings in bonds. They did everything right. They listened to their advisor. They diversified. They still lost. Meb Faber, chief investment officer at Cambria Investment Management, posted publicly in real time. He called it the worst year ever for a 60-40 portfolio on an after-inflation basis. Not bad. Not rough. The absolute worst in the entire documented history of this strategy. The strategy itself is rooted in Harry Markowitz's modern portfolio theory published back in 1952. Markowitz argued that combining uncorrelated assets maximizes return for a given level of portfolio risk. Bonds and stocks were the perfect uncorrelated pair. At least, that was the dominant assumption. The 60-40 was popularized aggressively through the 1980s and 1990s by institutional advisors everywhere. It fit perfectly into a specific economic environment that was quietly building the entire time. Starting in 1982, the Federal Reserve began the longest bond bull market in recorded financial history. Interest rates fell steadily for 40 years, from 16% all the way down to near zero. As rates fell, bond prices rose. Every single year, bonds delivered capital appreciation alongside income. That 40-year tailwind was not a feature of the strategy. It was the entire strategy. The 60-40 did not succeed because of elegant theory. It succeeded because of one trend. When that trend reversed in 2022, the portfolio had no remaining structural foundation beneath it. Carson Group researchers stated this plainly. The 60-40 was a rate-dependent misinterpretation all along. Pre-1980, before the Great Bond Bull Run, positive stock-bond correlation was the historical norm, not exception. Stocks and bonds moved together, not apart, through the Great Depression, World War II, and after. The Vietnam era, the oil shocks, the 1970s stagflation, bonds provided zero real protection then. The post-1980 era tricked an entire generation of investors and advisors into a false assumption permanently. They assumed negative correlation between stocks and bonds was a financial law. It was merely a cycle. State Street research published in October 2025 confirmed the exact scale of this structural regime shift. The average stock-bond correlation from 2010 to 2021 sat at negative 0.37, reliably negative, consistently protective. From early 2022 onward, that correlation flipped positive in average plus 0.41 across the following 3 years. Positive correlation means stocks and bonds move in the same direction at the same time. That is the exact opposite of what the 60-40 needs to function as designed and sold. State Street data showed stocks and bonds declined simultaneously for 14 consecutive months starting in early 2022. 14 months. That is not a blip. That is a regime. A new structural economic environment entirely. The 12-month correlation peaked at an extraordinary 0.82 in July 2024, the highest in 2 decades. For context, a correlation of plus 1.0 means 2 assets move in perfect lockstep together constantly. At 0.80, bonds were barely distinguishable from a second equity position inside the same portfolio structure. The 40% bond allocation was providing almost zero diversification protection at the peak of this correlation. BlackRock called this shift a new regime, not a temporary condition, but a structural transformation in markets. The foundational relationships anchoring traditional portfolio construction are shifting, BlackRock stated directly in their 2025 fall directions. The change may endure, they said, due to persistent inflation dynamics, policy action, and fiscal imbalances. Those are three separate forces, and all three remain deeply embedded in the current macroeconomic environment today. What drives this positive correlation? Inflation. That is the critical variable underpinning the entire dynamic shift. When inflation is the dominant macro concern, it hurts both bonds directly and equity valuations simultaneously together. Bonds lose value because real yields must rise to compensate investors for deteriorating purchasing power going forward. Stocks lose value because higher discount rates compress the present value of future corporate earnings predictably. Both asset classes get hit by the same macro bullet, and diversification between them collapses to zero. State Street's research framework made this dynamic crystal clear using a specific analytical ratio for precision. When inflation volatility is rising relative to growth volatility, stock-bond correlations turn positive, without exception. When growth uncertainty dominates over inflation concern, correlations turn negative and bonds regain protective properties. The entire question for investors is now this: which regime are we actually living in right now? Inflation peaked in June 2022 at 9.1%, the highest reading since November 1981 in America. The Federal Reserve's own 2025 GDP forecast was revised down from 2.1% to 1.6% gradually. Tariff policy, geopolitical disruption, and persistent service sector inflation are all keeping the pressure elevated structurally. BlackRock's Q2 2026 outlook stated that investors are demanding higher compensation for holding long-term bonds now. 10-year U.S. Treasury yields rose to 4.28% during the week of March 14, 2026, providing no equity refuge. Iran's disruption of the Strait of Hormuz drove oil prices higher, pushing inflation expectations upward simultaneously again. BlackRock stated directly, "Government bonds and gold are not providing ballast as equities fall in this environment." That sentence, published in April 2026, is one of the most consequential statements in modern portfolio theory history. BlackRock CEO Larry Fink went further in his 2025 annual letter to shareholders published in early April. He declared the 60-40 portfolio may no longer fully represent true diversification in the current investment environment. He proposed a new model entirely: 50% equities, 30% bonds, and 20% private assets. Real estate, infrastructure, private credit. These are the new diversifiers Fink believes belong in every portfolio now. JP Morgan's 2026 long-term capital market assumptions echoed this framework almost precisely in their published research. JP Morgan now refers to the traditional 60-40 as a foundation and calls the evolved version the 60-40 plus. Their plus model adds private equity at 7.5%, real estate at 7.5%, real assets at 7.5% additionally, plus 4.5% private credit and 3% hedge funds, the bond allocation shrinking, alternatives expanding into the gap. The message from the two largest asset managers on Earth could not be any clearer or more urgent. The strategy that built retirement wealth for 60 years needs a fundamental structural rethink starting right now today. JP Morgan's model is not a minor tweak to the classic strategy at all. It is a fundamental reimagining of what a diversified portfolio actually means today. And JP Morgan is not alone in that conclusion, not even close to being alone. Morgan Stanley's Global Investment Office now recommends up to 25% alternatives in portfolios directly. They cite inflation hedging, income potential, and stability as the core reasons for this recommendation. Apollo Global Management published research in February 2026, examining portfolio data from 2006 to 2025. Their analysis covered nearly 2 full decades of real market performance across public and private assets. A traditional 60-40 of public stocks and bonds returned just 7.3% annualized across that period. Adding private market exposure incrementally increased returns and simultaneously reduced portfolio-level risk throughout that same time frame. A portfolio with 100% private markets delivered 10.3% annualized over the exact same period. That is a 3 percentage point annualized gap, compounded over decades. That gap becomes genuinely life-changing wealth. 3% extra annualized return on a $500,000 portfolio compounded over 20 years adds roughly $450,000. That is not a rounding error. That is the difference between a comfortable retirement and financial pressure. The private markets argument is powerful, but it comes with a critically important and honest caveat. Private markets are illiquid. You cannot sell them on a Tuesday morning when markets open down sharply. Minimum investment thresholds historically locked out most retail investors from accessing private equity and private credit. Morningstar's Amy Arnott warned that a 20% private asset allocation is aggressive for most individual investors. She suggested keeping additional alternative asset classes to under 5% each to manage correlation risk carefully. Her recommendation reflects a broader tension inside this entire debate about the future of portfolio construction. The institutions, BlackRock, JP Morgan, Apollo, Morgan Stanley, are pushing hard toward private market integration. The retail-focused analysts are urging more caution, citing liquidity risk, transparency gaps, and access barriers. Both sides are responding to the same underlying problem. The two-asset model is no longer sufficient. Morningstar's own diversified test portfolio demonstrated this clearly with real 2025 performance data they published. Their test portfolio included 20% large-cap U.S. stocks and 20% international stocks across emerging and developed markets. It added 10% each to treasuries, U.S. core bonds, global bonds, and high-yield bonds for income, plus 5% each in U.S. small-cap stocks, commodities, gold, and REITs for real asset exposure. That diversified structure returned 18.3% in 2025, 500 basis points above the plain 60-40 portfolio. 500 basis points of outperformance in a single year is an enormous and practically meaningful difference. But here is the honest nuance that most YouTube finance channels will not tell you at all. Over a full 20-year rolling period, traditional portfolios generated better risk-adjusted returns than broadly diversified structures. The diversified portfolio shines brightly in specific environments, particularly when U.S. dollar weakness and inflation dominate markets. In calmer, low inflation, U.S. dollar-dominant periods, the simple 60-40 tends to catch up and sometimes surpass alternatives. 2025 happened to be a year where dollar volatility boosted international equities and gold simultaneously and substantially. That specific combination of macro conditions made diversification look brilliant, and it genuinely was brilliant in 2025. The key question for investors is not whether 2025 favored diversification. It obviously and measurably did. The question is what the next 5 to 10 years look like structurally for inflation, rates, and deficits. The U.S. federal debt has now crossed $36 trillion. The Congressional Budget Office projects it rising substantially further. Persistent fiscal deficits require ongoing Treasury issuance, hundreds of billions of new bonds entering the market annually. More supply of bonds without proportionally rising demand mechanically pressures bond prices and pushes yields higher continuously. BlackRock identified this exact dynamic in their Q2 2026 outlook as a structural driver of elevated bond yields. Investors are demanding term premium, extra compensation for the risk of holding long-duration government debt today. That term premium demand is not a 2022 story. It is a 2026 story continuing in real time. When term premium rises, long-duration bonds become risky assets rather than safe havens, structurally, not cyclically. Investors holding 20-year Treasury bonds inside a 60-40 framework are holding one of the most volatile instruments available. The duration risk embedded in long bonds means a 1% rise in yields drops bond prices by 20%. At current yield levels and deficit trajectories, that interest rate risk is not theoretical. It is present and alive. State Street stated it plainly. The 60-40 playbook worked under the previous 40-year period from 1982 to 2022. What worked under that specific and extraordinary period will be far less likely to work going forward structurally. So what does the evidence suggest investors should actually consider doing with their portfolios right now in practice? The first practical response is shortening bond duration inside the fixed income allocation immediately and deliberately. Shorter duration bonds, those maturing in 1 to 7 years, carry dramatically less interest rate risk than long bonds. TIPS, Treasury inflation-protected securities, adjust their principal value automatically based on the consumer price index for protection. Floating rate debt also adjusts its coupon upward as interest rates rise, providing natural protection in rising rate environments. The second practical response is geographic diversification beyond the U.S. stock market for the equity allocation itself. In 2025, international equities dramatically outperformed U.S. equities as the dollar weakened against major global currencies broadly. The MSCI EF index of developed international markets posted strong gains, while the S&P 500 faced tariff-driven turbulence. A portfolio concentrated entirely in U.S. equities carries deep home country bias that most investors dramatically underestimate and ignore. The third practical response is adding real assets, commodities, gold, infrastructure, and real estate investment trusts selectively. The Bloomberg Commodity Index returned approximately 16% in 2022, the exact year stocks and bonds both collapsed simultaneously. Commodities are not correlated to either stocks or bonds in the traditional directional sense that defines the 60-40 structure. They respond to supply-demand dynamics, geopolitical disruption, and inflation expectations, three forces entirely separate from equity earnings cycles. Gold specifically has been a standout performer in 2025 and into 2026, reaching all-time price records repeatedly. Gold crossed $3,000 per ounce in early 2026, driven by central bank buying, dollar weakness, and geopolitical risk globally. Infrastructure assets, toll roads, pipelines, data centers, utilities, generate inflation-linked cash flows with low correlation to public equities. Bridgewater's all-weather portfolio, designed by Ray Dalio specifically for all macro environments, included both gold and commodities deliberately. That framework outperformed the 60-40 in 2022, precisely the year the traditional structure failed most catastrophically and visibly. The 40-30-30 model gaining traction among institutional allocators, 40 equities, 30 bonds, 30 alternatives, reflects this same logic precisely. LPL Financial Analysis confirmed that 40-30-30 would have yielded meaningfully better results in 2022 than the classic structure. The alternatives sleeve provides returns uncorrelated to traditional stocks and bonds, which is the entire point of diversification. None of this means the 60-40 is entirely worthless or should be immediately abandoned by every investor everywhere simultaneously. The 12-month stock-bond correlation dropped from 0.80 in mid-2024 all the way back down to just 0.16 by late 2025. That normalization suggests bonds are beginning to reclaim some of their traditional diversification properties as growth fears replace inflation fears. The 60-40 returned 17.2% in 2023, approximately 15% in 2024, and approximately 15% again in 2025. Those are 3 consecutive years of strong performance that any investor would have been very satisfied to receive. But here is the critical difference between defenders and critics of the 60-40 framework in the current debate. Defenders point to those 3 good years as evidence of resilience, and those years are genuinely real and valid. Critics point to those 3 good years as a product of cooling inflation and falling rate hike expectations specifically. The moment inflation reaccelerates, whether from tariffs, energy shocks, or fiscal dominance, the correlation turns positive again fast. And in April 2026, BlackRock confirmed that the Iran conflict sent the stock-bond correlation to its highest level in 2 years. That single sentence from BlackRock is the entire argument in one line. The vulnerability never fully went away permanently. The 60-40 does not have a permanent problem. It has a conditional problem tied directly to the inflation regime. Understanding that condition is the most important thing any investor can do with their portfolio right now in 2026. If inflation stays contained, bonds diversify, and the 60-40 survives adequately for moderate risk investors seeking simplicity and income. If inflation reaccelerates, driven by tariffs, geopolitical energy shocks, or fiscal deficits, the correlation turns positive again fast. In that scenario, the bond allocation becomes a liability instead of a protection mechanism for the entire portfolio structure. The evidence from BlackRock, JP Morgan, Morgan Stanley, State Street, and Apollo all points in the same direction clearly. The old model is not automatically dead, but it is no longer automatically safe the way it once was. Every investor holding a 60-40 portfolio needs to ask one honest question about their current allocation right now today. Are the bonds in this portfolio actually protecting me? Or am I simply hoping the macro environment stays cooperative? If the answer involves hope rather than analysis, it is time to look seriously at what the structure actually contains. Subscribe to Finance Insight right now and hit the bell. This information belongs in every investor's hands today. Drop a comment below and tell us, are you still holding a 60-40, or have you already started making changes?